Fine. Very good. So yeah, if we look at, it'll be difficult to sort of talk it through with obviously the slides, but hopefully you can incorporate some of these slides into your piece. But when we look at the market currently and the state of play in the UK, obviously we've got to be wary that the UK is looking like it potentially slip into recession in 2023. But all our indicators on the plus side are showing that from 2024 onwards, there's definitely a positive improvement in the market. That will be factored by what's happening with the base rate at the Bank of England. If they can get it back down to their sort of favoured mark of around 2%, then we'll be in a very, very strong position to see growth in the property market as well. And it's something I'll expand on in a little bit. And the next couple of slides show that quite well. So if you look at consumer price index, which is a good sort of indicator in terms of what the market is saying and where we are, we see this falling and inflation falling to 3.4% by the end of 2023. Bear in mind that was down from a high of around 11%. So all the indicators are pushing in the right direction. So we're expecting, as I said, the return of the Bank of England's 2% target by 2025. Now that's quite a big statement and a big play, because if that does return to 2%, it will bring more people to the market because mortgages will be cheaper, so that more first-time buyers can access the property market, which helps drive the pricing. And that's where we see the price growth that we have done in the last few years. It is worth noting, though, we are not over the worst of it. We do see the base rate peaking at 4.5% next quarter. So obviously in the short term, there's going to be a bit of pain, but there's definitely opportunity in the long term. So that's what we're saying to investors based in Hong Kong or anywhere based overseas, is if you're looking at buying something that's off plan, then that's where your opportunity is. Get something that completes in 24, 25, and you'll tie it in with lower interest rates and definitely an upturn in terms of market activity and sentiment. Moving on to GDP and the outlook and what we're expecting to see. So unemployment is definitely rising throughout 2023, which will obviously have an impact in terms of where we see the property market. There is definitely more stock coming to market, but there is a real lack of people that can afford to buy it at the moment, which is why we're seeing that negative downward trajectory on pricing in the short term. But we definitely see that improvements from 2024, and this slide gives you a good indication of where we are at the moment, but where our indicators are predicted to get to in terms of house price movements and house price growth over the next sort of 3 to 4 years. If we then go into the specifics of the actual property market itself, which will be probably a bit more useful for you guys. So the first one that we always look at is what's happening in the mortgage market, because ultimately the mortgage market is probably the biggest influencer in terms of house prices, in terms of their actual sale price and achievable prices in the open market. Now, mortgage rates have definitely increased across all loan to values, and we are expecting them to remain sort of elevated in the near to or short to near terms. But we are predicting that decline in the base rate that will definitely alleviate some of that affordability pressure. So at the moment, with increased inflation, people are sort of feeling the pinch. They've got less money, disposable money to spend, so they're not able to afford the mortgages that are available in the market. If you look at this bottom line here, this is the base rate. So obviously it's increased a fair bit over time, but if we bring it back down in line with previous years, then there's a good chance that we'll be in a position where these are all 2-year fixed rates. So if these 2-year fixed rates, depending on the loan to value, so obviously the lighter colours, if we're looking at 95%, often the higher amounts borrowed are from your first time buyers. Your more seasoned investors will probably be borrowing slightly less, at let's say 60% loan to value. Obviously if that can drop in, then the affordability factor will be a big play in that market and help drive sales. It will bring more people to the table that can actually afford to buy property. So this is a good slide to sort of determine what sort of levels we are in terms of the amount of stock in the market compared to the amount of people looking to purchase. So the number of sales is actually 11% higher today than we were in 2019. Now, last year was a bit of a freak year, probably because post-COVID, a lot of people, especially domestically in the UK, wanted to drive sales, and that drove the market quite hard. But in recent weeks, that demand has really picked up again, and it's at its highest level since October, and demand is 16% higher than in 2019. So when we actually look at this graph, what's it showing us? So the lighter blue is what the market was doing in 2022 versus 2019. So this is the demand in the market. So you can see there was a drop-off in demand versus 2019, but the number of sales agreed as well was a lot lower than it was in that market. But interestingly, you had 65% more homes were available for sale in terms of in last year compared to what we had previously. So there was more stock available for people to purchase. What we're seeing in 2023 is the complete opposite of that, a real decline in stock numbers and stock levels. So that's really going to be our big driver and our big focus on this market. So we've zoomed it in specifically to what we're seeing in London. So London is as an overall is going to see a greater drop in terms of recovery this year, but then it's going to bounce back quicker than the rest of the UK. So again, depending on mortgage affordability, this is sort of London is the dark blue, the UK as a whole is the lighter blue. So you can see in terms of price forecasts and what we've expected for 2023, but then obviously the growth building again 24, 25, 26. And as you can see, London, while in the negative, is doing maybe slightly worse than London as the UK as an average. As soon as that line starts picking up, London continuously outperforms the rest of the UK, which is a real positive sign. And that's where which brings me on nicely to this one. We've broken it down into each sector. So if we look just focusing on London, this is what we saw in 2022. So about a 6.7% average growth in terms of the residential real estate market. A lot of that is going to be, and some is going to be wiped out in 2023, with the majority of those losses having happened in Q1 and probably where we are at the moment, with the market being in a place it is. But what we're saying to people is the opportunity is coming of buying something now that's a couple of years off plan, because the growth in 25, 26, 27, you're looking at getting that 20. There's still a positive outlook in terms of 6.9% growth compound over that period. So that's what we're focusing our buyers and investors and saying is the growth opportunity is there. When you factor in, and what we're going to talk about in a second, on the lettings market and how well that's achieving for individual investors, there's definitely a huge opportunity when it comes to buying property and holding property long term. But as we often say within CBRE, is you've got to be looking at a minimum 5-year hold is where you're going to see the greatest return on any sort of investment. So this is why we're going to see that growth, is because there's a real lack of stock coming to the market. So what we've done is we've compared it to the last peak in terms of where we saw most amount of growth was in 2015. So this is this section highlighted here. This was a good growth year in terms of, and these different lines all indicate applications, which is people going in to try and build something, permissions that have been signed off by local authorities, so what they're looking at potentially actually building, the starts, which are quite important. So these are people where spade's gone into the ground and they've actually started building. And then obviously most importantly, the completions. So that's when keys are in hand, people are moving in. And as you can see, that line has been on the decrease for a little while now. Compared to the 2015 peak, applications alone are down 23%. permissions, which is people, going through that planning process, is down 31%. And actually, quite importantly, construction starts, people with the spade in the ground starting that process, down a massive 46%. So when we talk about where opportunity lies, opportunity is really around here, because if people own flats now, then there's not enough coming to market. So if we're down 46%, this might not affect the market now, but you'll see it in 3 years' time is when it affects the market, when there's more people looking to purchase or looking to rent. And because construction starts are down, there's not going to be enough stock to keep everyone happy and keep everyone in a place they want to be, which is where we see the big spikes in values. Now, this is quite interesting in terms of against the government targets, how many units we're actually building. So there's a significant unmet demand in London. So we're 46% below the target number. So the target supply for London of new homes alone, 52,000. Whereas we actually only did, I think it was about, we did about 26,000. We're just over 24,000 homes short of where we need to be, and that's just for 1 year. So when you start to collate that over 2 years, 3 years, 4 years, compound that up, suddenly in a 5-year period, you're close to 100,000 homes short in the capital. And that is why we've seen the massive increase in rental demand, and that's why we've seen the massive increase in house prices, because there is quite simply not enough stock being built to hit the demands that we're seeing within the capital city. And where that is even more heightened is when you move into prime central London markets. So PCO is prime central London. What do we mean by prime central London? Often the golden postcodes, W1, WC1, so around like Covent Garden, Mayfair, Kensington, those sort of really prime areas where property values will always be north of £1 million. So here on the left, this is the demand since 2019, 2020, 21. You can see there's been heightened demand in terms of unit numbers coming to market. And the different colours indicate the values. So the darkest is at 1 to 2 million, and then the lighter up we go is the values are getting higher and higher and higher. Now, interestingly, you look at the supply, and it's quite clear to see that supply is going in a negative trajectory in terms of where we are on houses being built across all of those different price points. So the demand is definitely there. Now, one of the big drivers of that demand is, as you can see on the left here, is the overseas market. Now, what we've done is, since this is the direct saving on a like-for-like purchase of, let's say, £1 million. So since 2016, a Hong Kong buyer has saved themselves 15%. Since March 2022, that's still 8% saving. So when people often come to us and they're negotiating property and they say, I would like to get a 5% discount, usually a buyer would be quite happy with a 5, 6, 7% discount. Well, if we're saying you may still be able to negotiate a bit of discount, but on top you've already got to factor in that currency play, you're basically then guaranteeing yourself pretty much a double-digit discount on whatever you buy. And that is definitely still something I think people sometimes overlook when they're buying, is in real terms compared to where they were a year. And if I go back a couple of slides and our projections for what we predicted the growth in the economy to do in the UK, the pound on the back of that will strengthen. And as it strengthens, not only are you making money in terms of the property value going up, but you're making money on your currency play. So in 3 or 4 years' time, if you sell your property that's worth £1 million now, which might be worth 10 million Hong Kong, but you sell it for £1 million in, 2 years' time, that suddenly might be worth 11 million Hong Kong at that point. So you've got to look at both factors when it comes to that sales process. And then we touch on probably the biggest market mover recently has been the rental market. And as I was talking about earlier, tenant demand has basically far outstripped supply since the start of the pandemic, since sort of this is dating all the way back since December 2012. But really, when we look here, sort of some of the changes and where the graph really picks up is over that COVID period and what we've seen. There's just not enough new landlord instructions transactions coming to market to keep up with what the tenant demand is showing. And then because of that cost of living crisis I talked about earlier, because everything's becoming more expensive, there's less of an ability for people to be able to afford to buy, so they're staying in rented for longer. So as they're staying in for rented for longer, it's also driving up the pricing because there's more people choosing between a far, far lower amount of stock on the market. So all of sort of these combined factors are really helping drive that rental price growth in a positive direction. Now, in terms of actual figures for you, so London again is outperforming the rest of the UK quite comfortably. So annual increase in rents on new tenancies up to March 2023, you're looking at just shy of 12%. And that's in Greater London. So there is still a huge amount, and you know, that's in a short period of time. When you put that over, I think it's 17% over a 12-month period, 17 to 18%, and we're not seeing that slowing down anytime soon. I fully expect that rate to continue upwards. As I talked about, the lack of new build completions coming to market, more and more people moving back into central London. This will only increase in the upward trajectory. So you probably expect to get to sort of 15-16% growth over the coming year in terms of the rental market. And this is exactly what I was talking about. This is the rental market projections over a 5-year period, similar to what we looked at with the sales market. London, again, is performing very well compared to the rest of the UK. And if we look at it in terms of 2022, 23, you know, even when we say the sales market might be struggling in 2023, but that lettings market is definitely achieving, and then it will sort of even itself out, but we're talking good increases with a 17% return. So you're locking something in today, you've got the potential of a 7% property growth with the currency play of, let's say, 8%. And then you've also got to factor in a 17% rental growth as well. So all your long-term indicators, which are the most important in my view to look at, are all pulling in a positive direction. Even with bumps in the road and difficulty with the economy's unemployment, cost of living crisis, the lack of supply and the overwhelming demand is still pointing to positive pictures when it comes to key takeaways for the UK and specifically London residential market. So probably for you guys, what would be most interesting, some of our key takeaways and what we're looking at. So inflation that we talked about, that was one of Rishi Sunak's Prime Minister's pledges for this year, was to halve it by the end of 2023. That will obviously help bring that Bank of England base rate hopefully back down to that magic number of 2%. And that will then obviously drive the mortgage market, that will bring more buyers into the market, which will help drive subsequent prices of units. As you can see there, point number 2, the market is stabilised and interest rates expected to drop, as I just mentioned, by the end of this year. We forecasted total completions for 2023 of 46% below the target of 52,000 homes per year. So that's a massive number, and that's probably off the back of COVID, as in people, they didn't down tools, but there was harder to get staff, harder to get materials. So we're seeing, you know, we always knew there'd be a hangover from it, and that's probably the main hangover we're seeing. But the big one is rental growth is going to continue to be strong in 2023, with London to see within the sales market, London will see some falls this year, but definitely a strong recovery in 2025 and beyond, with sort of 7% growth happening over that 5-year period. So that's really our headline figures, and that's where we're hoping to see the market play out, and what we're looking to sort of achieve for our investors over the next sort of 3 to 5 year plan.